You've probably heard the whispers. A financial titan, silently pulling the strings of global finance, influencing markets, governments, and trillions of dollars of wealth without most people ever knowing its name. That name is BlackRock. Today, on the Billionaire's Playbook, we're diving deep into the true story of how this company rose from obscurity to become the most powerful asset manager in the world, and why its power might be more terrifying than you think. Picture Wall Street in 1988. The markets are booming, the big banks dominate, and a handful of young financiers walk into a small New York office with a dream most would call crazy. They believed that risk itself, the unpredictable heartbeat of finance, could be measured, charted, and tamed. Among them was Larry Fink, a man shaped by loss, driven by obsession, and haunted by the fear of repeating past mistakes. After losing nearly $90 million in mortgage-backed securities earlier in his career, Fink became fixated on one idea: understanding risk could be the key to dominating finance. The firm they founded was called BlackRock, originally as part of Blackstone Financial Management. Almost immediately, they began focusing on something Wall Street usually ignored: fixed income assets, things like bonds and debt that were boring to most investors but fundamental to the real flow of capital. But behind the scenes, something far more powerful was being built: a technological engine that would become the central nervous system of global investing. They called it Aladdin, not a fairy tale, but a digital brain capable of processing risk in ways humans never could. It measured portfolios, dissected exposure, predicted outcomes, and linked markets across time zones and continents. It wasn't just software, it was a global financial supercomputer that could see the unseen, anticipate the unexpected, and manage the unmanageable. By the early 2000s, this secret weapon would become BlackRock's crown jewel, and the reason even governments came knocking on their door. BlackRock's strategy wasn't about short bursts of growth, it was calculated conquest. In 1999, the company took a monumental step. It went public, selling shares on the New York Stock Exchange and signaling that a new giant was rising in finance. From that moment on, BlackRock didn't just manage assets, it began to accumulate them on a scale no one could have imagined. One acquisition after another followed. In 2004, BlackRock bought State Street Research and Management, expanding its reach and its capabilities. In 2006, it absorbed Merrill Lynch Investment Managers, adding even more muscle. Then came the game changer. In 2009, BlackRock acquired Barclays Global Investors for $13.5 billion, bringing under its control the massive iShares ETF platform, the world's largest exchange-traded fund business. Overnight, BlackRock went from a powerful firm to a financial leviathan. What made that acquisition so seismic? ETFs, exchange-traded funds, had transformed investing. They allowed money to flow into entire markets, entire regions, entire sectors with a click. Instead of betting on one company, investors could buy into whole segments of the global economy. And BlackRock controlled the biggest ETF network in the world, meaning its influence stretched into nearly every market. But that was just the beginning. When the 2008 financial crisis hit, most financial firms collapsed under the weight of their own risk. Banks failed, markets froze, and entire economies teetered on the edge. BlackRock didn't just survive. It was chosen by governments to help manage the crisis. Its Aladdin platform, its risk analytics, its mastery of data became so essential that central banks and regulators turned to BlackRock to value toxic assets, restructure portfolios, and engineer solutions to systemic collapse. They had become too indispensable to ignore. In the aftermath of that crisis, BlackRock's assets exploded. What was once billions became trillions. By 2015, BlackRock managed over $4 trillion. By the early 2020s, that number had more than doubled. In 2022, BlackRock crossed $10 trillion in assets under management, a figure so vast it rivaled the GDP of entire nations. And by 2025, that figure had soared even further. BlackRock's assets under management hit over $13 trillion, driven by record inflows into its iShares ETF business. Successful strategic acquisitions including Global Infrastructure Partners, HPS Investment Partners, and Prekin, and expansion into private markets that generate higher fees and deeper client relationships. But let's be clear, BlackRock doesn't own all of these companies in the traditional sense. They manage the investments on behalf of their clients. That's a critical distinction often lost in sensational claims. The wealth they influence belongs to pension funds, sovereign wealth funds, and millions of individual investors. But the power lies with BlackRock's decision-making and algorithms that determine where that money flows. That power has turned BlackRock into more than just a financial institution. It's become a force of influence on the global stage. In 2025 alone, the firm pushed into infrastructure on a massive scale, engaging in deals worth billions to control critical assets, including moves into key global trade routes, energy systems, and utilities. In some cases, such investments have sparked diplomatic and political tension, as nations question what it means when a private financial entity has stakes in strategic infrastructure. This influence hasn't gone unnoticed. Environmental groups like the Sierra Club Foundation have pulled money away from BlackRock, criticizing it for backing off from aggressive climate action and climate-related shareholder resolutions. A stark reminder that corporate power doesn't just shape markets, it shapes the future of our planet. Political reactions have been equally dramatic. BlackRock's environmental, social, and governance, or ESG, strategies have sparked debates, bans, and backlash from Republican-led states in the U.S., leading the company at one point to exit the Net Zero Asset Managers Initiative under political pressure, a move that laid bare how geopolitics and finance now intersect in ways few anticipated. Amid all this controversy, one of the most profound shifts has been BlackRock's embrace of new frontiers, cryptocurrency, and digital assets. A decade ago, BlackRock's leadership was openly skeptical about Bitcoin and other digital currencies. Today, BlackRock's product suite includes digital asset offerings, tokenized funds on blockchain platforms, and some of the largest Bitcoin investment products in the world. This move didn't just expand BlackRock's reach, it legitimized crypto in the eyes of institutional investors, creating a seismic shift in how digital finance is perceived globally. But here's the unsettling part. As BlackRock's influence has grown, so too have concerns about its control over corporate governance. When a fund like BlackRock owns significant shares of countless companies worldwide, it gains the power to sway board decisions, executive compensation, environmental policies, and long-term corporate strategies. Combined with voting influence in markets, it puts BlackRock in a unique position, one where its decisions can ripple across entire industries and communities, often without public scrutiny. Critics argue that this concentration of capital creates a new form of market power, not through direct ownership, but through influence over outcomes. When BlackRock votes on shareholder resolutions, when it advises governments, when its Aladdin system forecasts risk scenarios, it is shaping reality itself. And unlike public governments, BlackRock answers primarily to its board and clients, not to voters. Some conspiracy theories exaggerate this reality. For instance, the claim that BlackRock owns everything. But while that's false, it highlights a deeper truth. BlackRock touches nearly every corner of global finance. It doesn't literally own all businesses, but it manages investments in them. Meaning when BlackRock allocates capital, it sends a message that markets listen to. This immense reach is neither random nor accidental. Decades of strategic growth, technological innovation, and calculated risks have made BlackRock a central pillar of the financial world. From bonds to ETFs, from risk analytics to digital assets, from infrastructure to emerging markets, BlackRock's footprint is everywhere. Yet its inner workings remain opaque to most of the public, hidden behind data screens and SEC filings. So, what does the future hold? BlackRock has already declared ambitious goals, including massive expansion into private markets and technology integration that could dwarf even its current scale. According to internal targets, BlackRock aims to raise hundreds of billions in private fundraising and potentially double its market value by 2030. Cementing its dominance not just in public markets but across every asset class. As the world hurtles forward, one thing is clear: BlackRock isn't just managing money, it's shaping the architecture of the global financial system. And while that might bring stability to some, for others it raises serious questions about power, accountability, and whose interests truly come first. If this story intrigued you, hit subscribe to the Billionaire's Playbook and don't miss our next deep dive into the hidden engines of global power. We break down the facts, uncover what's beneath the surface, and bring you the truths they don't put on the balance sheet.